Hi folks, welcome to part 2 of equity settled share-based compensation plans. And in this case, we're going to be looking at stock options because options are what gives you the right to common shares, which are equity, and we're going to look at them based on forfeitures. So in other words, what happens if people decide to forfeit their options and they leave before the vesting period ends? Well, again, if they leave throughout the vesting period, anybody who leaves and is entitled to options forfeits that right. So they don't get the opportunity to exercise the options after the vesting period ends. So what we need to do is estimate the amount of forfeitures or the value of the forfeitures that we have each year, or I should say the value of the options each year, based on what we know of the forfeitures. Because if people are forfeiting, that means people are staying, right? They're either forfeiting or they're staying, right? So using the forfeiture data, we can actually come up with estimated numbers of people that we think, or an estimated percentage of people that we think will stay. So therefore, if we have a look at this data, we're going to use this data to figure out how much compensation expense we would debit and how much contributed capital we would debit, taking into account forfeitures. So let's look at our example here. We see that on January 1st, 2008, 30 employees are granted stock options for 250 common shares each. So each employee can get 250 shares if they exercise their options. So that means the company will be giving 7,500 shares, and the option price would be $25 a share. So employees could buy those shares for $25. Now, the options will vest 4 years after the grant date. So we've got all of 2008, 9, 10, and 11. And the options are valued using an option pricing model at $60,000. So now, remember from our last video, we did say that any options that we had that were issued as a result of an equity settled share-based compensation plan, we don't adjust the fair value of the options after the grant date. It stays at the value it was at the grant date. So now, we also see that management has put together some likelihoods of the numbers of people they think will remain of the 30 people. So we can see here that we expect 87% of our employees, or 26 of 30, to remain throughout 2008, 80% to remain throughout 2000 and throughout the end of the year 2009. 23 people we estimate will remain up to the end of 2010, and of course we have not applicable in 2011 because by the time we reach the end of the vesting period, we're not going to be allocating any more compensation expense as well as contributed capital to the share options for anybody, because after that date there'd be nobody leaving, right? They'd be fully vested at the end of 2011. So whoever's there is there. And we do have data on this here. So in other words, we're not estimating anything there's no estimates by the time we get to 2011 because we know how many actually were there. 21 employees are still there of the 30. So those are the people, those 21 people will be entitled to receive options. Okay, at the end of 2011, because 9 people here have forfeited. So now, to make the journal entry taking these retention amounts in mind, let's see what it would look like. Well, the first thing we're going to do is we're going to set up a little bit of a table here so we can estimate the value of compensation expense each year and calculate the cumulative value of the contributed capital account for the stock options. So let's begin. We can see here that we've kept the fair value of the options at the same value it was at grant date, because that's a condition under an equity settled plan or an equity settled share-based compensation plan. We also see that every year we have a cumulative vesting fraction. That's the cumulative number of years that have passed throughout the vesting period. So we're going to take the fair value of the options every year multiplied by the cumulative vesting fraction and then multiply that by the estimated retention rate, which we got in the question, okay, in order to determine what is the required balance in the contributed capital account for the employee stock options. What we want to make sure of is that whatever value is in that shareholders' equity account is reflective of the value of the options that have the opportunity to be exercised after the vesting period is over. That's why it's important to have the estimated retention rate, because only the people who remain at the end of the 4 years are going to be able to exercise the options. Anybody who isn't there isn't going to have that opportunity. So we're interested in looking at retention rates. We're interested in the cumulative vesting factor because we want to know what the cumulative amounts are going to be. And in fact, this line gives us what the cumulative amounts in the contributed capital account need to be. All right, so we're going to weight it by a cumulative vesting fraction based on the number of years in the vesting period. So now when we do this math, when we multiply in 2008, 60,000 by a quarter times 0.87, we're going to find that we're going to need in our contributed capital account $13,050, and that's the amount we would debit compensation expense by as well. So that's why down here you have this journal entry that debits the compensation expense and credits the contributed capital for the option of $13,050. Now, if we get into 2009 and do similar math, we find now that in the contributed capital account we need $24,000. Well, we've already got $13,050 in it, so to shore it up, we're going to make a debit to compensation expense and a credit to that contributed capital account for the employee stock options of $10,090. Similarly, in 2010, we'd follow the same process, multiply these three numbers to get a required balance in the option account of $34,650. But don't forget, at the end of 2009, we already had $24,000 in it. So we're going to shore it up, okay, or top it up to get it to $34,650 through a $10,650 adjustment. And then, of course, by the time we get to the end of 2011, we had to calculate this number. It wasn't specifically given to us in the question. But now, because we're at the end of 2011, we already know what the retention rate is. Why? Or how do we know, I should say? We know because we had 30 employees, and we know that by the time we got to the end of 2011, 9 of them left. So 9 of them had left. Nobody left as at the end of 2011 in the vesting period. So therefore, we know that 21 remain because 9 left. All right, so we've got 21 left, and 21 divided by 30 is 70%. So we've done that calculation for you here. So now, these are the journal entries that we would do every year. And again, as I stated before, the contributed capital account is part of your shareholders' equity, and your compensation expense is an operating expense on the income statement. So this concludes this segment or this example on an equity settled plan with forfeitures using an employee stock option as your equity piece. And again, the option, when exercised, will be converted into shares. So again, that concludes this example. In the next example, what we'll do is we'll deal with a cash settled plan where we have stock appreciation rights with forfeitures.